Now, as you know that this chapter is about financial assets. Usually, if you look at your balance sheet, and in balance sheet under current assets, we have these three main accounts. The one of them is cash, then short-term investment, or it is also called marketable securities, and then receivables. So this chapter is about that what are necessary entries while using these accounts, and what may be the adjusting entries at period end. As we have discussed in class, the three main topics, that is bank reconciliation statement, then receivables, and lastly we have discussed short-term investment. Now, why these are important? Because we will have to manage the cash. Means what are the requirements of cash for the business, where we will get this cash and where we will spend this cash. So all these are highly liquid assets. That is called, the one is cash and cash equivalent. The second is your marketable securities, or in British terminology, we may call it as investment in securities. And the third one is account receivable. So all these, for example, if we are talking about cash, its valuation is face amount. Like if we have 1,000, it means that we have 1,000. While in short-term investment, like marketable securities, we basically, it is judged by its current market value. For example, a month ago, you have invested in some stocks or shares of a well-known company. Say its amount was 10,100,000, and now after a month, its market value is increased, and say it is 11,100,000. So we will have to make adjusting entries to record this 11,100,000. In the same way, for receivable, because receivable shows your debt sales are the services that you have rendered and yet you have not received your amount. So it is kept in receivable. It may be some of your customers fail to pay. So we also make adjusting entries, and we calculate net realizable value. So you should know that how all the three main assets that is categorized under financial assets, that how these assets are reported in our balance sheet. We have already discussed this cash in detail. Cash is defined as any deposits bank will accept. Like it is in the form of checks, or it is in the form of paper money, or it may be coming from traveler's check, or it may be from bank credit card sales, money orders, pay orders, and so on. So the other thing that is mentioned in balance sheet under current assets, it is basically cash equivalents. These are very liquid short-term investments, and very stable. Its values are very stable, and usually its maturity is within 90 days. Now, some of them is restricted cash that you can use, even it is available in your accounts, but you can't use it. And sometimes you will get line of credit facilities, and you can use this money as it is required for the business. Now we discuss after detailed discussion of all these cash and cash equivalents and overall financial assets. We need to reconcile our cash account with the cash account that is maintained in company's accounts, and this account is available in bank as well. So there need to reconcile. So for this purpose, we are getting bank statement and we reconcile it with our maintained cash account in our ledgers. So what is meant by reconciling bank statement? As you can see in the screen, that explains the difference between cash reported on the bank statement and the cash balance in depositor's accounting record. Depositor accounting record means the company's accounting record. So it also provides information for reconciling journal entries, because at the end we need to make a journal entry for adjustment. Like it's a journal format. For example, if you are receiving this statement from bank, nowadays it is available at every time, because due to online banking, you can get this statement. But in earlier days, the bank usually sent this statement to company or the account holder at the end of month. Now, like here we have balance per bank. It is available in your accounts, and just you add it, deposits in transit, and you deduct outstanding checks. And if you have committed some errors, that error may be corrected by adding or subtracting, and you will get adjusted balance. So like the balance per your account or company account, then again here we add credit memos, like you will get interest amount or dividend amount in such cases where bank have credit to your account. So you should update your account as well. Similarly, bank can detect some service charges or not sufficient fund checks penalty. So it would be deducted from your account. So you should also deduct this amount from your cash account that is maintained at your company account. These are called, deduction is called debit memos, while addition in your account is called credit memos. In the same way, bank may commit some errors, so it can be so you in your account it may be some errors, so you can adjust these errors by adding or subtracting, depends upon the error. So again, you will get the adjusted. So these two adjusted balances should be equal. It means that you have reconciled it. Now, for example, here are the questions that I have already explained. That you can see that here the adjusted balance is same. Like here you can see that 7207, and then here 7207. Now it is basically given you, this balance is also given you, and second balance while attempting your questions. So these two balances are given, and we will have to make adjustment. Like bank deposit is added, and bank error is adjusted whether it is positive or negative figure, and outstanding checks are deducted, that it is already discussed in the statement. In the same way, depositors record, the balance is given to you, the interest you are getting from bank is added, and not sufficient fund penalty, it is penalty or the amount as well as it is also detected, and penalty sometime is given separately, and recording error also, and it are subtracted. So this is your bank reconciliation statement, and you will have to adjusting entry as you are getting interest from the bank, because earlier you have not recorded it. So because cash is coming in the business, cash is debit, and this interest revenue will be credit. Similarly, there was error in the your account in inventory. So inventory is debited by 28 because it is an asset. In the same way, account receivable, because it was not collected due to non-sufficient balance. So it is also again debited, and your cash would be credited because now you have deducted, this cash is deducted from your account. So this journal entry is also needed. Now the second is marketable securities. Marketable securities, the idle cash is invested in bond or in stock of another company. In British terminology, we may call it as share. Now, in bond, you will get this amount as well as revenue. And in stock, you can get dividend as well as your asset may get appreciated or it may get depreciated. For example, you have purchased a share for 100, it may go rise, for example, to 110, or it may decline to 80. So accordingly, we will have to make adjustment. And readily marketable available means it can be sold or purchased anytime. So these are liquid securities. Now we will have to make some adjustment. Now it is about account receivable. Now in account receivable, for example, at the end of period, you will have to make adjustment. Like here it is mentioned that at the end of each period, record an estimate of uncollectible accounts. It is basically an estimation. It is not the correct figure. And later on, you will have to make adjustment as well. So it is called, in just terminology, uncollectible accounts expense. That this is the amount that you will not able to get back. And we have credit account allowance for doubtful accounts. So it is just like accumulated depreciation account that is called contra asset account, and the first account is a part of income statement, and the second account, that is allowance for doubtful accounts, is a part of balance sheet account. So whenever you are asked to make an entry of this adjustment after estimating, so you will have to make this entry after estimation. And in balance sheet, basically, it is appear like this one. Account receivable amount, for example, it is 100, and allowance for doubtful accounts, for example, it is 2. So net realizable accounts would be 98. Means that you will able to get only 98. And but in some cases, when an account is determined to be uncollectible and it is no longer qualified as an asset, it should be written up. So sometimes you are asked to make a journal entry for writing off. So for writing off, we use this journal entry, allowance for doubtful accounts, debit, and account receivable credit, because account receivable is an asset account, and when you credited it amount will be received, it means that you will not get this amount. For example, here is assume that on January 5, KMX determined that Justin Clark would not pay the 500 he owes, because he will have to pay 500 to your business, but now he's not able to pay you back because of it may be a number of reasons. One of the reason it may be that bankruptcy. So allowance for doubtful accounts would be debit and account receivable with particular customer name like this one may be credit. Whenever you are asked to make a journal entry for writing off, then we use this type of journal entry. Then you can maybe earlier that you will not able to get back your money, but later on it is determined that one of the customer is willing to pay you back. So for this purpose, we usually make two entries. So here is explanation that assume before this entry, account receivable balance was 10,000 and the allowance for doubtful account were. It is, I'm sorry, it is again about this entry. Now the entry that I was discussing, it is basically recovery of previously written off account. So here we basically make two journal entries. The first, again, you are getting the amount, so account receivable will be debited and allowance for doubtful accounts would be credited. And after receiving the cash would be debited and account receivable would be credited. So this entry is basically called action or recovery of earlier writing of accounts. So all these are about different entries that are related to your account receivable. Now, here we have some other examples as well. For example, at December 31st, 2005, this is about monthly estimates of credit losses. Sometimes you were asked to record these credit losses in another way, like this. At December 31st, 2005, musical lands accounting records indicate the following: account receivable 50,000, allowance for doubtful accounts 200. So past experience suggests that 5% of receivable are uncollectible. So it means that we will get the 5% of our credit sales. So here, let's say our this account receivable that was 50,000 and its 5% is 2,500. So this 2,500 is the amount that you will not able to get. Earlier in the balance, it was 200. So you will have to make some calculation to arrive at this figure, 2,500. And we have already 200 balance. So the difference would be 2,300. So we will make the adjusting entries of 2,300, not 2,500. Why? Because 200 was already available in the allowance for doubtful accounts. So adjusting entry, again the same that we have already discussed in the start of account receivable entries. Like you can see that account, uncollectible accounts expense and allowance for doubtful accounts. Now let's look at another way to estimate the uncollectible accounts. We have another ways as well, and that is called balance sheet approach. So estimating credit losses through the balance sheet approach. Sometimes it is mentioned in the question that how you can estimate your credit losses while using balance sheet approach. So here, year-end account receivable is broken down into age classification. And then we calculate the bad debts amount, and then we make total amount, and then we make adjusting entry that I have explained already different questions while making the solutions. Now, like here we have the aging. For example, overall, you can see that here, just a minute. Yes, this one. Overall, we have 67,000 in account receivable. So its aging is that current account receivable are 45,000. The account receivable that is due from the customer within a 1 month is 15,000. And in the same way, in the 2 months are 5,000 balance, and the over amount that is more than 2 months is 2,000. So how we calculate our bad debts? Let's, from the past experience, we determined that we will not able to get 1% of the current receivable, 3% of the receivable that is fall within 1 month, and the same way other categories. So we calculate its percentages amount, 45,000, 1%. We have 450 in the same way. Overall, bad debts amount, we have 1350. So this is called balance sheet approach. Or earlier we have discussed, you can get this amount by using the overall, like this one, 50,000 receivable were given, and we have calculated 5% on average. But here we were provided aging, and accordingly, we calculated overall bad debts amount that is 1350, and the balance again, the balance was given 500, and the 1350, the overall bad debts amount. So the difference amount is 850. So we will make adjusting entries of 850. So we have another alternative for uncollectible accounts is as well. Uncollectible accounts percentage is based on actual uncollectible accounts from prior year's credit sale. So you can take an idea that what would be the fewer these uncollectible accounts. So focus is on determining the amount recorded on the income statement as uncollectible. This is basically, you can get the idea from your sale. It is called income statement approach because this sales is the part of your income statement. And account receivable is the account of balance sheet. That's why that was called balance sheet approach. And as credit sale or simply sale is a part of income statement account, so that's why it is called income statement approach. So we just multiply by percentage that you can guess from your prior history. So here is an example. That's the uncollectible accounts percentage based on actual uncollectible accounts from prior years. Like here is the example that historically 1% of accounts have been uncollectible. So our overall sale is, let's say, 60,000. Here it is mentioned in the question 60,000, and just will make 1% of 60,000. So 600 would be collectible. So there are different approaches to get these uncollectible accounts. And again, the entry would be, if prior we don't have any balance, then we will directly write this uncollectible account expense to allowance for doubtful account. So here you can see that we have 3 approaches. This is income statement approach that depends upon sales. We will just take the percentage of sale. Then aging of receivable, it is because receivable comes under balance sheet. So after the aging, we will get this uncollectible accounts. Here we will get this uncollectible accounts from sale. Here we will get from accounts. In the same way, we will also get this percentage of overall receivable. This is also called balance sheet approach. In balance sheet approach, we have these two different. The one is detail analysis, that is of aging. So these first two are balance sheet focus. Why we regard balance sheet? Because we will get the percentage of receivable, and receivable is the part of balance sheet. Here, the aging of receivable and gain receivable is part of balance sheet. And sale is part of income statement. That's why it is called income statement growth. Then sometimes these uncollectible may be written off directly. So if you are asked to write these uncollectible accounts expense directly, then we will make this entry. You should also know this entry as well. Directly uncollectible accounts. And here, instead of creating an allowance for doubtful accounts, you directly credit account receivable. So this is all about account receivable. Thank you very much. If you have any question, then you can